I think fundamentally, one of the issues that we see today is that there is just a significant amount of capital and a significant amount of demand to enter the space. And while the macroeconomic drivers for the space remain, long-term, there's going to be a lot of capacity created and there is a lot of potential. The short-term realities are that it's highly crowded. Above the 5 gigawatt capacity mark, you have 4 developers, Greenco, Renew, Tata Power, and Adani. Between 1 and 5 gigawatts of capacity, we've identified over 20 groups. And this is based on an analysis of operational projects, projects under construction, as well as projects which have been awarded.
Welcome to the Blue Circle. It's such a big privilege and pleasure to connect with everyone and our distinguished keynote speaker, who is handpicked because of the think input and the rich experience he brings in. Thank you also to our distinguished audience for joining us, most of whom are CEOs, CXOs, and senior leaders. Many of them are our members and our repeat visitors. Sorry, I think there was a lag, which ultimately determine the evolving complexion of the market. Along with our weekly webinar series and our digital publication, you will be happy to know that we have recently launched the first version of the Blue Circle app for industry professionals, somewhat like the sector-specific LinkedIn, a space to have meaningful conversations, connect with over 15,000 plus like-minded leaders from India and across the globe, house high-quality curated content, and access business opportunities across these sectors. Now, without further ado, I'm pleased to introduce today's keynote speaker, Mr. Rahul Goswami, founder and managing director of Greenstone Advisors, an investment bank focused exclusively in the Indian renewable energy market. Greenstone advises developers and investors in capital raising and M&A transactions. Rahul has more than 13 years of experience exclusively in renewable energy transactions and has completed over 50 deals and engagements representing over $10 billion in capital commitments. Rahul has worked with clients including the Aditya Birla Group, CPPIB, Renew Power, Tata Power, Torrent Power, Cleantech Solar, KKR Virescent, NL Green Power, and others, and pretty much everyone under the roof. Prior to moving to Mumbai, Rahul was based in New York and completed renewable energy transactions with General Electric, First Solar, BP, Goldman Sachs, JP Morgan, Morgan Stanley, Siemens, and others. Again, pretty much everyone under the roof. And for today's topic, Mr. Goswami will be discussing intensity of competition in the renewable energy sector. Now I request Mr. Goswami to please begin the session. Thank you.
Sure. Well, thank you, Gautam. It's a pleasure to be introduced. I definitely have not worked with everyone under the sun, but fortunately, I've had the privilege of working with a number of the institutions that you did mention. So happy to, share my thoughts on the renewable energy sector overall, and I think specifically on this topic about what we're seeing in terms of the competitive landscape. High level, I've always been passionate about renewable energy, and especially when it came to the decision to move to India, to me, it was quite clear that a lot of value would be created in energy and that renewables would have a big role to play. And with a leap of faith, I moved in 2014 and we began the work that we've been doing ever since. But what's been interesting, I think, is that the market globally, but I think specifically in India, is just incredibly dynamic. And where we are today is, again, I think an inflection point of where this market will go. And I think broadly, some of the themes that I wanted to touch on, and happy to have an interactive session, is the high level buzz of interest in the renewable energy sector in India versus the underlying realities of how difficult it is to build these businesses. I think fundamentally, one of the issues that we see today is that there is just a significant amount of capital and a significant amount of demand to enter the space. And while the macroeconomic drivers for the space remain, Long term, there's going to be a lot of capacity created, and there is a lot of potential. The short-term realities are that it's highly crowded. Above the 5 gigawatt capacity mark, you have 4 developers: Greenco, Renew, Tata Power, and Adani. Between 1 and 5 gigawatts of capacity, we've identified over 20 groups. And this is based on an analysis of operational projects, projects under construction, as well as projects which have been awarded. And under the 1 gigawatt threshold, we have more than 25 developers, including some newly created platforms who have significant pockets of capital that they will be looking to deploy. And I think, for us, especially as advisors, our role is to help developers in raising capital and in M&A transactions. Taking a step back, our view is that it'll be very difficult for 25 plus 4 plus another 25, whatever that ultimate number is, to really exist meaningfully in the next 5 years. So we think that the sector will consolidate. We believe that the platform valuations that helped a lot of the developers, the low debt costs that also helped developers over the last several years, those upsides are no longer present. Platform values have stabilized, and in some cases they're coming down. Debt rates have increased, and the recent allocations of capacity, which have not yet been commissioned, the clock is ticking. So I think that you have two dynamics here. One is obviously global interest in renewable energy, net zero, these types of themes, interest in India, interest in the Indian renewable energy space, but an on-ground situation which is hyper-competitive and has driven many developers to bid very aggressively to make certain assumptions, which we'll have to see if they'll fructify. And I think that's the genesis of I guess the topic today.
Understood. So I think, do you have a presentation which you would want to take forward with, or?
Not a presentation. I thought this was supposed to be an interactive.
More interactive, sure. So then we wait for a few questions. I think one question already popped up by Rahul Arora. He's asking, how can policies affect the export performance for renewable energy sector?
The export performance. So this would be with regard to, I'm guessing, module manufacturing, solar module manufacturing.
I'll wait for Rahul to respond to that. But if you were to look at it from more perspective, both on larger or smaller, if you want to get that bifurcation, we would be happy to hear that.
Sure. So what I would say is that when I think about policies, I mentioned module manufacturing because that is, I think, what has been most meaningful in terms of a policy announcement in the last year. Essentially, I'm sure most of this forum is aware, but the government introduced this 40% basic customs duty on the import of solar modules. And I think that this is a very complex topic. To address the question, how will, let's say, this policy affect export performance? Well, at its core, the intention of the policy is to encourage domestic module manufacturing. And we have seen and we have worked with some of the domestic module manufacturers that internationally there is a significant amount of demand for modules, and the reliance on China is something that clearly is being questioned. So there is this global geopolitical shift to start looking at areas outside of China for certain pieces of equipment, solar modules certainly being one of those. And so I think that the BCD policy has, to some extent been helpful to encourage many groups to look at this opportunity very seriously. You have one of the major players, Reliance, who, at least from what we understand, is approaching this in a very serious and meaningful way, acquiring numerous platforms, technologies, and what we see is a genuine interest in building true leadership in domestic module manufacturing. And then you have a number of other players, large as well as smaller ones, who are also trying to move in a similar direction. So what does this mean from an export perspective? If these facilities do end up getting established, and if the technologies are competitive, then yes, the market globally is big enough that I would expect that there's enough demand for many of these groups to start selling their modules internationally. We have seen amongst the domestic players that exist today, their shares in certain cases go from 20% to 30%, if not higher, in terms of international sales. But I think a separate part of this topic, the way that I'm understanding it, is with regard to the impact to the domestic sector itself. And here I probably have a bit of a different view, which is that I'm not certain that it's beneficial to the sector. Ultimately, it's the analogy that I like to draw is to one of, let's say, computer chips. AMD, Intel, these are the dominant forces in making the chips that go into people's PCs and computers. Clearly, it's a huge global market, and there's concentration risk on few companies. But if India were to say that we would apply, because it's such a large market, duties on computer chips, the net result would be the cost of computers would go up. The cost of business then would go up. The ultimate returns of these businesses would therefore be impacted. So in a similar way, I consider power to be an essential service, which I think the country does as well. And adding duties to one of the core components of what is clearly driving a lot of the new generation additions has the impact of increasing the price of power. And that means that the cost of doing business theoretically does go up for everybody. And so it is a fair position to argue that reliance on one country for such a critical component or set of components is a risk. But it also needs to be considered in the context of what this is, which is a technology as well. To build a successful module manufacturing business, I think that you don't need millions of dollars, you need billions of dollars. And you should be thinking about this in terms of decades. So whatever the module technology was that people used 4 years ago is certainly not what they use today. So it's a constant, it's a business that requires constant investment in R&D, constant innovation. And I do think in certain businesses, certain markets, there is a point where it's just too late. And while India is now focused on a certain set of technologies, what we understand is China is already on to one or two levels ahead. So I just think that we'll have to see how this plays out. Clearly, there will be some beneficiaries. Some of the domestic module manufacturers will benefit. But fundamentally, India needs power, and renewables will drive a lot of that power addition, the power capacity addition. And this policy does fundamentally increase the cost of that power addition. Whether the domestic market can catch the Chinese manufacturers, we'll have to see. But today it seems like at 40%, that may not even be enough.
Interesting. I love the analogy you also mentioned about Intel and its chips adding more cost to the computers, etc. So it really gives a wider view of what you're actually pointing in terms of the cost additions in the renewable energy space as well. I'll come to the next question. It's an anonymous attendee, don't know the name. But the question is, how are delayed power purchase agreements affecting competition?
Understood. So my interpretation of the question is that counterparty risk in India is arguably one of the biggest risks in the sector. Will I get paid, and will I get paid on time? And there are a number of discoms who are not paying on time. And how does this affect the competitive landscape? What I would say is that It's a good question and it's a complex one. The impact to the competitive landscape will be specific to the group in question. And there are a certain number of variables that I would think about to, to address this question, which would be, what is the exposure that any particular group has to a certain set of counterparties? What is the quantum of that exposure in terms of scale and capacity? And how diversified are these groups against, asset classes, counterparties, and also timing? How many, when they start building projects, and what cash flows do they have that are stable? What I would say is, again, if I were to think about the market from a few different buckets, the very largest developers, and then kind of the smaller ones, the larger developers are far better positioned, I would argue, from a certain perspective, which is that if you look at, let's say, a Renew Power or a Tata Power or a Greenco, a lot of their operational assets were developed and commissioned many years ago. And so there have been, issues across, various platforms. These are systemic issues. They affect everybody, not one specific developer. But if you have 3, 4, 5 gigawatts of operational cash flows, which have kind of gone through cycles, but are still generating cash flow, you can survive, these types of shocks, whether it's module prices increasing, whether it's one counterparty not paying on time, whether it's, court dispute that's happening over a particular set of tariffs. So I think one of the key learnings we've picked up is that diversification at scale is incredibly important in the space, and concentration risk is something to be very careful about. And by that, I mean, when you're building a large portfolio of assets, if you are, making a very significant bid in a particular state, and for whatever reason that state chooses not to pay, or there's something that happens that affects your cash flows, then you are disproportionately affected. So delays and counterparty payments, depending on the DISCOM, impact everyone, and it's not good. But the differentiator, I think, boils down to the ability for somebody to survive and then to continue to build capacity. If I have 200 megawatts that's operating, and then 200 megawatts that I bid for, and my 200 megawatts were exposed to counterparties that are no longer paying, and I have debt payments now that are due, this creates a lot of pressure. What happens is that your future growth gets chilled. If I have, operational assets at scale which are diversified, my counterparties aren't paying, but I'm still capable of servicing my debt. Yes, I'm taking a short-term equity impact, but these are long-term assets. And if I have a long-term view, then these cycles will continue, and I'm going to continue to bid and build new capacity. And what will happen, or what we started to see happen, is that, the larger players are marginalizing the smaller players, especially when these cycles happen. Everyone gets hit, but we see smaller groups disproportionately get impacted, and their growth chills. The overall economics of whatever they have are really jeopardized, and I think that it is a fundamental issue that affects everybody. But at this stage, there are groups at scale, and again, this will vary depending on the exposure that somebody has, who the counterparties are, the sponsorship, how much equity you have, but scale, I think, matters.
Thank you. I'll move on to the next question quickly. It's from Madhav Arora. He's saying the renewable energy sector faces huge investment gaps. How can green bonds and sustainable finance help?
Okay, so what I would say here is I would have a slightly different view in terms of the financing gaps. And it depends what we're discussing. So if we're talking about traditional solar project, wind project development, that's one category. The newer category is what we like to call complex energy solutions. So these are round-the-clock projects, hybrid projects, projects involving energy storage, and in some cases pumped storage, pumped hydro storage, which are far more expensive and far larger. And there's also green hydrogen projects. What I would say is that traditionally, when people refer to renewable energy, they're referring to the first bucket that I talked about, a solar project, wind project, which is primarily the types of assets that have been developed over the last 5 years, decade plus in India. And here, going back to what I said earlier, the sector is well capitalized. You have enough developers who have equity, who are willing to acquire, fund, bid good quality assets. So from an equity perspective, we don't really see a funding gap. And if you look at any of the auctions that have taken place in the last several years, actually, all of them have been fully subscribed, if not oversubscribed, and sometimes 2x, 3x, up to 8 times. So fundamentally, is there a liquidity or capital availability issue for building traditional solar and wind projects? Our view is no. The market has demonstrated that because auctions are subscribed. When it comes to the debt portion, are developers able to raise the debt financing against these projects? I mean, the answer is yes. As an asset class, especially in infrastructure, renewables has been a relatively good asset class for lenders as well. More and more lenders want to participate. There is interest from international commercial lenders now, which is also increasing. There is interest from development finance institutions. Where debt becomes a problem is when you hit the scale levels of these multi-gigawatt or larger platforms, in which case the lenders that they have worked with do have certain limits. You can't have billions of dollars of exposure just to a single developer, even if that developer is highly credible. And I think that has created, some challenges for certain larger groups. So what I would say is that if I were to kind of, again, go to large versus small, and there's this middle bucket too, small and middle largely should not have too much of an issue raising debt financing, in our view, if the quality of the projects are good. The larger groups, again, on any independent project, should not have that issue, with the exception of their overall debt exposure and their limits to any particular lender. But they've been able to solve this, partially coming back to the point about green bonds, using bond financing. So typically these bonds are dollar denominated, although there are now rupee bonds. And what a lot of these groups have done is they've taken local debt financing with the relationships they have, who understand construction risk, who understand land acquisition risk, who understand approval risks, and use that type of financing to execute their projects. Once the projects are stabilized and operational, then they bundle them and they'll issue a bond against it. And those bonds are a different source of capital, which frees up their limits to continue to go back to their existing domestic relationship banks and execute. So in this regard, the green bond financing market has been very helpful. The issue with the bonds is that if they're dollar denominated, then you're taking FX risk. And that means that you have to, in most cases, the groups will hedge it, usually 100%, but in some cases, maybe a little bit less. But once the tenor of that bond matures and you have the repayment that's due, you do need to address refinancing. And the international markets have not, at least in the limited examples that you can see with Azure or Renew Power, they've not really priced or valued these businesses the way that we see these businesses being priced or valued domestically by private investors. And that does create issues. So when there's a cycle like what's happening now, a little bit less so, but certainly over the last 6 months, the dollar bonds that have been issued by some of these great developers in the international markets were trading at material discounts, basically implying that the risk of getting repaid was higher. And as a result, Renew did refinance a number of these green bonds by taking them back to the domestic market. So on the bonds point, I don't think it's really too relevant for small, mid-sized developers. I think it becomes much more relevant when you need to diversify your sources of debt financing, primarily due to borrower limits. And even then, it doesn't mean it's a perfect option for financing, because it has its own nuances that can make them favorable or unfavorable depending on the cycle.
Oh, thank you. I'll move on to the next question by Vaibhav Chadda. He's saying that what's your view on the PV manufacturing industry? Does the market have scope to add more capacity domestically? And where do these players stand in terms of tech compared to Chinese players?
Sure. So does the market have the capacity to add more domestic manufacturing capability? I mean, the answer is yes. The amount of deployment opportunity in India globally is clearly massive. So from a, again, supply demand perspective, there's going to be tremendous amount of demand for solar modules. Now, that still means you need to have a good quality product to sell. And that, I think, ties into the second question, which is that how does the technology compare to, let's say, the Chinese manufacturers? Just one other point on the first piece. The government has issued certain auctions, these CPSU auctions, where it is required that developers use domestic manufactured modules, in which case there's a clear opportunity that you need domestic modules. Also, this ALMM list, approved list of module manufacturers, is basically mandating that you use modules from this list, which happens to be comprised of almost entirely domestic manufacturers. So from a policy perspective, which is both ALMM and then the government's own projects where they require this, then yes, there's a sort of a captive area of opportunity where the international technology manufacturing capability that is completely irrelevant. But if I were to strip that out and just say that I'm a developer, my job is to build high quality renewable energy assets. And my job is not really to be, developing technologies and modules. How do I think about this when I'm bidding for the next SECI tender or NTPC tender, or whatever it might be? Our view is that generally these groups have been and probably will remain technology agnostic. Whoever is providing the best option for me, best solution holistically, is the one that I should consider. Now, if that's coming from a domestic source, it's coming from an international source, honestly should be irrelevant. But when I look at the criteria that somebody would logically use, it's clearly in favor of the international groups. Track record. Has this supplier installed these modules or these products in other areas in India? What is the track record of that? For India, you have a very limited set of installations with existing domestic groups. Bankability. Will this manufacturer be there in 20 years to replace my module, to honor their guarantees? Well, if it's a new company in India that's starting up, I don't actually know. And especially if their balance sheet is 10, 50, 100 million, 200 million, that's very weak in the context of what some of the Trinas of the world would have. What is their technology performance? Well, there's very limited track record. So the technologies that they're looking at today are probably equivalent to the good technologies that have been in place in China, but the newer age technologies are certainly being driven by international markets. So I think when it comes to bankability, deployment scale, performance, cost per megawatt, every single metric is going to probably favor an international group. There's only one which the government has used policy to make more favorable for domestic manufacturers, and that's adding a 40% duty to imports and also restricting the types of modules that can be used in a particular project to whatever's qualified on the ALMM list. But I would say that logically, if I'm a technology agnostic developer, if today I can only buy from ALMM, then fine, I'm going to choose the best options available in the market. If that is not the case, then I'm going to choose the best options that are available in the world. And I would think that if there isn't this duty and there isn't ALMM, I'm pretty sure that it would be highly favorable towards the existing, multi-gigawatt, dozens of gigawatt sized module manufacturers that already exist.
Understood. So I'll just quickly move on to the other two questions because I think we're shooting a little more over time. First question is that in terms of stationary energy storage, do you see any other technology becoming feasible in the long term as compared to lithium-ion batteries? And the second one is keeping the Australian-Singapore power project in mind, do you foresee India exporting energy to other countries?
So both of these topics are areas that I don't want to pretend I'm an expert on. So the first one, which is with regard to energy storage technologies, is not easy because I'm not a technology expert, and it's very difficult from at least our experience just looking at transactions for somebody to pick the right technology. You really need to have strong technical expertise and understand the space. Historically, the strategy to identify the best technology has been I don't think there is one. There's a lot of different bets that people will make, and it's almost like a VC strategy. You can write off 60%, and then you're ending off with winners that end up taking over the market. Lithium ion clearly is preferred. There's plenty of other types of technologies that are demonstrated in labs that don't use lithium ion technology, but the ability to scale these technologies and keep them, commercially viable is a huge question mark. So we are seeing these. We're trying to understand and learn more. It's difficult for us at Greenstone to take a call because we typically focus on transaction sizes which are, at least 50, 100 million plus, and we aren't really looking at technology companies. So we would rely on developers to be able to take these calls. And if you're a developer and you're building projects of this scale, you're going to want to work with credible names and proven technologies, unless you're in the space itself. So I guess on the first question, are there any other credible technologies outside of lithium ion? There are promising ideas and there are promising demonstrations, companies, and technologies, but nothing that I would be able to say is clearly superior or clearly going to take over lithium ion. Conceptually, yes, we can see this, but today is very tough to make that call. On the second point about India's ability to export power, I'm not so sure. Again, this is probably an area that I've not studied as much because we do focus mostly on the domestic market, although we work with the international investors coming into the domestic market. But to export power, you need transmission lines. And transmission lines, especially transmission lines being built underwater, are not easy to build, and they're very expensive. So the question is, how do you evacuate the power? So India has great solar resource. You can build projects in India for a very low price, but that's only one part of the equation. The other part is the transportation of that energy and how much does that cost? So it depends on what type of asset class we're discussing. And, certain things like what was mentioned are at such a level of scale, and they're using, different types of asset classes that, yes, that could make sense. But the evacuation of, let's say, just renewable energy per se to other geographies, that's not a topic that comes up frequently. I think there's enough to do domestically that export of energy is not something that really is viable today.
Understood. Just to add here, I did come across I think about 2 months ago, where Sri Lanka was looking for a credit line for the solar and renewable transmission line for the electricity, basically, from India to Sri Lanka or China to Sri Lanka. So they were still exploring which of the two countries would be a better or a viable option for providing that energy to Sri Lanka. So we're hoping that India could be an export market, both in the electricity space and from renewable energy space specifically. So yeah, but
it's interesting, and certainly, I think the geography is closer to India. There could be that opportunity. let's see. Offshore wind had a lot of discussion earlier, and it's yet to materialize because of cost. So a lot of these ideas have academic merit, but when it comes down to cost, the levelized cost of energy at the point that you need it, a lot of these things break, or they just take time until that number actually makes sense. So academically, I can completely understand the merit.
True, I agree. But on this note, thank you so much, Rahul. It's such an insightful and engaging session. And I'm sure our guests and I have been hooked on till the end, and I've taken home 7 nuggets. And thank you to our leaders in the audience also for joining us and for staying till the end.
Okay. Thank you so much, Gautam.
Okay. See you soon.
Take care. Bye-bye.